How did Michael Burry predict the housing bubble? Hello viewers, welcome to my YouTube channel. Today in this video we will talk about how did Michael Burry predict the housing bubble. Michael Burry has been one of the greatest financial players, but unfortunately, not many knew about him since 2015. It was in 2015 that Paramount Pictures released The Big Short, which helped Michael make millions out of a prediction. He profited from the subprime mortgage crisis that occurred from 2007 to 2010 in the United States of America. Not many people believed Michael initially, however. He is known to have a lot of say as to how the market will move over in the coming years. Other predictions put forth by Michael Burry regarding the collapse in 2022 real? Michael Burry is an interesting figure. A one-time medical doctor, he made a fortune by correctly predicting the subprime mortgage crisis of 2008. We'll look at the housing market leading up to the crash, and what indicators Burry used to make his prediction. We'll also explore whether or not another housing bubble is on the horizon. Burry's prediction of the housing bubble was based on a number of factors. First, he noticed that home prices had been steadily increasing for a number of years. This was not sustainable, and he knew that eventually prices would have to come back down to earth. He also noticed that more and more people were taking out subprime mortgages. This meant that they were borrowing money from lenders who were giving them loans they could not afford. As the number of people with subprime mortgages increased, Burry knew that there would be more defaults and foreclosures. This would lead to a decrease in home prices, and he predicted that this would happen in 2007 or 2008. Who is Michael Burry? Michael Burry is an American investor, hedge fund manager, and physician. He is the founder and managing partner of Cyan Capital, a hedge fund he ran from 2000 to 2008. During that time, Burry achieved notoriety for his accurate predictions of the subprime mortgage crisis and the global financial crisis. Burry was born in 1971 in San Jose, California, the son of a Taiwanese immigrant father and a German-American mother. He attended the Pediatric Group, a private practice in San Jose, before going on to study economics and psychology at Vanderbilt University. After graduation, he worked as a doctor for a year before enrolling at Columbia Business School. It was while working as an analyst at a small investment bank that Burry realized his true passion was investing. In 2000, he founded Cyan Capital with $1 million of his own money. Over the next 8 years, the fund grew to $700 million in assets under management. During that time, Burry made some highly profitable bets against the subprime mortgage market and the housing market more generally. He correctly predicted that the housing bubble would burst and that this would trigger a financial crisis. These bets made him one of the most successful hedge fund managers of his generation. In 2008, Burry closed Cyan Capital to outside investors and returned all their money. He has said that he plans to continue managing his own money and will not reopen the fund to outside investors. Reliability of the predictions. Michael Burry founded a hedge fund in Cyan Capital during the year 2000. During the time, he was considered to be a wise and talented value investor. It was then when he attracted Joel Greenblatt and managers of the Vanguard Group. Cyan saw 55% returns when the S&P dropped by nearly 12% in 2001. Michael had then predicted the internet bubble, after which he delivered the profits to his clients. Michael Burry sold these profits by short-selling the most overvalued tech stocks. He solidified his reputation as a gifted investor by being successful repeatedly. Sadly, this reputation was not enough when asked about his predictions when the subprime mortgage presented the risk. Surprisingly, in 2005, he predicted that the entire housing market would collapse. Despite being a renowned investor, several clients refused to believe him. However, Michael was proved right in 2007, which cemented his credibility as an expert in the market. Possibility of a collapse in 2022? In mid-February of 2021, Michael stated, "The market is dancing on a knife's edge," only because his investors were unsupportive of him. With having evidence of the increase in the S&P 500 index, a crash is inevitable. According to Michael Burry, the part of the issue is a general transfer of assets from actively managed funds to passive index funds, which he preferred to call passive investing's IQ drain. Inexperienced investors are jumping into the stock market, and it seems as if the danger is amplified via the new trends. For instance, GameStop went from less than $20 per share to $483. Then down to about $50 per share in less than 30 days. The most noteworthy thing is that Michael generated a profit of $270 million profit from GameStop. There has been a sudden increase in the interest of call options by none other than the inexperienced traders. These call options, when leveraged by professionals, can indeed be profitable. What is the housing bubble? The housing bubble was a period of extremely inflated prices for housing that eventually ended in a market crash. Michael Burry, a hedge fund manager, is credited with being one of the few people to correctly predict the bubble's collapse. Burry noticed that mortgage lenders were offering increasingly risky loans. and that bundling these loans into securities was becoming more common. He believed that the securitization of these subprime mortgages would eventually lead to a financial crisis. In 2005, he bet against the housing market by purchasing credit default swaps. When the housing market collapsed in 2007 to 2008, he made a huge profit. Many people believe that the housing bubble was caused by a combination of factors, including lax lending standards, investors seeking higher returns, and low interest rates. The collapse of the housing bubble led to the financial crisis of 2007 to 2008, which was the worst economic downturn since the Great Depression. The crisis caused a wave of foreclosures, unemployment, and bankruptcies. How did Michael Burry predict the housing bubble? In the early 2000s, Michael Burry, a hedge fund manager and former medical doctor, began to notice some troubling trends in the housing market. He noticed that more and more people were taking out subprime mortgages, loans given to borrowers with shaky credit histories. He also noticed that the mortgage-backed securities, MBS, these loans were bundled into were becoming increasingly popular with investors. Burry believed that the housing market was in a bubble, and that it would eventually burst. He took a bet against the MBS market by shorting it, meaning he essentially bet that their value would go down. And he was right. When the housing market collapsed in 2008, the value of MBS went down with it, making Burry a fortune. While some have criticized Burry for profiting off of the housing crisis, it's important to remember that he didn't cause the bubble or the collapse. He simply saw it coming and positioned himself accordingly. What are the consequences of the housing bubble? When the housing bubble popped in 2008, it sent shockwaves throughout the world economy. Millions of homeowners lost their homes to foreclosure, while others saw the value of their homes plummet. The crisis also had a ripple effect on the stock market, with banks and other financial institutions losing billions of dollars. The fallout from the housing bubble is still being felt today. In the United States, many people are still struggling to recover from the financial crisis. And while the US economy has slowly begun to rebound, many experts believe that it will take years for the country to fully recover from the housing bubble. The consequences of the housing bubble are still being felt around the world. In Europe, countries such as Greece and Spain are still struggling with high unemployment and weak economic growth. And in China, where the housing market is also cooling, many people have lost money on their investments. The housing bubble has also led to stricter regulation of the financial industry. In the United States, the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in response to the crisis. What can we learn from him? Michael Burry is a value investor who made a fortune by betting against the subprime mortgage market. He is an interesting figure because he was able to see the housing bubble for what it was and make a bet against it. Burry's story is a reminder that there is always money to be made by being contrarian. When everyone else is buying, there are always profits to be made by selling. Burry's story also highlights the importance of doing your own research. He spent hours reading SEC filings and talking to investment bankers in order to get a handle on the subprime mortgage market. Finally, Burry's story is a reminder that sometimes the best investments are the ones that no one else is making. By being willing to take on more risk, Burry was able to make a huge profit when the housing market collapsed. In sum, Michael Burry is an excellent example of a value investor who made a killing by being contrarian and doing his own research. So this was our today's video. I hope you all like this video. Don't forget to hit the like button and subscribe my channel, and also share it with your friends and family. We will be back soon with a new video. Till then, keep supporting and take care. FTX is a Ponzi scheme. Collapsed. Game over. Hello viewers, welcome to my YouTube channel. Today in this video we will talk about FTX, that is a Ponzi scheme. It looks like FTX is turning out to be the biggest Ponzi scheme scam ever. This company promised to revolutionize the way we trade crypto, but it turns out they were just looking to make a quick buck. Now, people who have invested in FTX are being left high and dry, with no way to get their money back. If you've been scammed by FTX, or if you're thinking about investing in them, watch this video till the end. We'll tell you everything you need to know about this scheme, and how to avoid getting scammed yourself. What is FTX? FTX is a Ponzi scheme that has been masquerading as a legitimate investment opportunity. It promises high returns with little to no risk, but the reality is that it is nothing more than a scam. Investors who have put money into FTX are now facing huge losses, and the company behind the scheme is nowhere to be found. FTX has filed for bankruptcy protection in the US after it was unable to meet a torrent of withdrawals, marking a stunning collapse for Sam Bankman-Fried's crypto empire that was valued at $32 billion just months ago. The filing in a federal court in Delaware on Friday includes FTX's US entity, Bankman-Fried's proprietary trading group Alameda Research, and about 130 affiliated companies. What is a Ponzi scheme? A Ponzi scheme is an investment scam that promises high returns but instead uses money from new investors to pay older investors. Ponzi schemes are named after Charles Ponzi, who became famous for using the scheme in the early 1920s. Ponzi schemes are often disguised as legitimate investments. For example, in a Ponzi scheme involving a fake investment company, victims might be promised that their investments will be used to buy and develop land or to fund other projects that will generate high returns. However, instead of using the money to buy land or invest in legitimate projects, the operators of the scam simply use it to pay earlier investors, giving the appearance of profitable returns. Operators of Ponzi schemes can also use funds from new investors to pay themselves rather than investing it in a legitimate business venture. As long as there are enough new investors willing to put their money into the scheme, it can continue to operate and even grow. But eventually, there are not enough new investors and the scheme collapses, leaving many people out of pocket. Ponzi schemes are illegal in many countries because they involve fraud and deception. If you think you may have been scammed by a Ponzi scheme, you should report it to your local authorities or financial regulator. A Ponzi scheme, for those in need of a refresher, is an age-old fraud in which inflows of new money pay off earlier investors. But the story ends the same way: champagne for those at the top, tears for everyone else. US investigators have busted a handful of crypto Ponzis over the years. Among them is OneCoin, which was based in Bulgaria and which prosecutors allege brought in roughly $4 billion from investors around the world. How did people get scammed by FTX? There are a number of ways that people have been scammed by FTX. The most common way is through the use of Ponzi points. Ponzi points are a way for FTX to artificially inflate their prices and lure in new customers. They work by allowing customers to buy a currency at an inflated price, and then earn a commission on every sale made using that currency. The problem is that, because the prices are inflated, there is no way for customers to actually make any money from using the currency. In fact, they will end up losing money as the price eventually crashes back down to its real value. Another way people have been scammed is through the use of bait and switch tactics. This is where FTX will advertise one thing, but then deliver something completely different. For example, they may advertise an investment opportunity that promises high returns, but then switch the terms and conditions so that the customer actually ends up losing money. Finally, another common scam tactic used by FTX is called phishing. This is where they will send out fake emails or messages purporting to be from a legitimate company or website in order to trick people into giving away their personal information or money. What can you do if you've been scammed by FTX? If you've been scammed by FTX, there are a few things you can do. First, if you have lost money as a result of the scam, you should report it to the Federal Trade Commission. You can also file a complaint with the Consumer Financial Protection Bureau. In addition, you can contact your state attorney general's office and file a complaint. You should also consider contacting an attorney to discuss your legal options and whether you may be able to recover your losses through a class action lawsuit. What are the red flags of a Ponzi scheme? A Ponzi scheme is an illegal investment scam where money from new investors is used to pay off older investors. The scheme relies on a constant stream of new investments to keep it going, and eventually collapses when there are not enough new investors. There are several red flags that can indicate a Ponzi scheme. Number 1. Promises of high returns with little or no risk. Any investment that promises high returns with little or no risk is likely too good to be true. If it sounds too good to be true, it probably is. Number 2. Pressure to invest quickly. Ponzi schemes often rely on pressure tactics to get people to invest before they have a chance to think about it or do their research. Number 3. Unregistered investments. Most legitimate investments are registered with the Securities and Exchange Commission, SEC. If an investment is not registered, that should be a red flag. Number 4. Complex structure. Ponzi schemes often have complex structures and use convoluted language to make them sound more sophisticated than they really are. If you don't understand how the investment works, be wary. Number 5. No verifiable records. A legitimate investment should have clear records of where the money is coming from and where it's going. If there are no records or the records are vague, that's a warning sign. Number 6. Insider trading. Ponzi schemes often involve insider trading, which is illegal. If you're being told to buy or sell a security based on non-public information, that's a red flag. Number 7. Lack of transparency. A legitimate investment should be transparent about its operations, finances, and investment strategy. If you can't get clear answers to your questions, be wary. Number 8. Promises of guaranteed returns. There's no such thing as a guaranteed return on an investment. Anytime someone tells you that you're guaranteed to make money, it's a huge red flag. How to avoid getting scammed by a Ponzi scheme. Ponzi schemes are all about taking money from new investors to pay off older investors, and they always eventually collapse. If you're thinking about investing in a Ponzi scheme, there are a few things you can do to try to avoid getting scammed. Do your research. Make sure you understand what the investment is and how it works before you put any money into it. Be wary of promises of high returns with little or no risk. Any investment that sounds too good to be true probably is. Ask questions and get answers in writing. If the person trying to get you to invest seems evasive or unwilling to answer your questions, that's a red flag. Get everything in writing, including any promises made about the investment. This will help protect you if the investment turns out to be a scam. If you follow these tips, you'll be less likely to fall victim to a Ponzi scheme. So this was our today's video. I hope you all like this video. Don't forget to hit the like button and subscribe my channel, and also share it with your friends and family. We will be back soon with a new video. Till then, keep supporting and take care. Economy crash in last 3 months of 2022. Hello viewers, welcome to my YouTube channel. Today in this video we will talk about the economy crash in last 3 months of 2022. However, before we start our countdown, we would appreciate it if you would subscribe to our YouTube channel and also press the bell icon. So, let's get started. Introduction. The economy has been on a roller coaster ride in the last few years and it doesn't seem to be slowing down anytime soon. In the last 3 months of 2022, the economy took a nosedive and crashed. This was caused by a variety of factors, including political instability, natural disasters, and trade disputes. As a result of the crash, many people lost their jobs, homes, and savings. The stock market also took a hit, causing billions of dollars in losses. While the economy has since recovered somewhat, it's still not back to its pre-crash levels. Here are some things you need to know about the economy crash of 2022 and its aftermath. Causes of the crash. There were a number of factors that contributed to the economy crash of 2022. One of the primary causes was political instability. In the months leading up to the crash, there was a lot of turmoil and unrest in many countries around the world. This instability led to a decrease in trade and investment, which put further strain on the global economy. Natural disasters also played a role in the crash. A series of major hurricanes struck several countries, causing widespread damage and destruction. This led to a decrease in production and an increase in prices for many goods and services. The disaster relief efforts also put a strain on government budgets, further exacerbating the economic problems. Finally, trade disputes between several countries also contributed to the economic decline. These disputes led to a decrease in trade and investment, as well as an increase in tariffs and other barriers to trade. This caused further economic hardship for many countries involved in the dispute. The aftermath of the crash. The economy crash of 2022 had a devastating impact on many people around the world. Millions of people lost their jobs, homes, and savings as a result of the crash. The stock market also took a hit, causing billions of dollars. In the last few years, the economy has been on a roller coaster ride with many ups and downs. The most recent down was a crash that happened in the last 3 months of 2022. This was caused by several factors, including political instability, natural disasters, and trade disputes. As a result of the crash, many people lost their jobs, homes, and savings. The stock market also took a big hit, causing billions of dollars in losses. The economy has since recovered somewhat, but it's still not back to its pre-crash levels. So what does this mean for you and your money? Here are some things you need to know about the economy crash of 2022 and its aftermath. Number 1. Political instability can lead to an economic crash. Number 2. Natural disasters can also cause an economic crash. Number 3. Trade disputes can trigger an economic crash. Number 4. When the economy crashes, people lose their jobs, homes, and savings. Number 5. The stock market also suffers when the economy crashes. Number 6. The economy usually recovers after a crash, but it takes time and doesn't always return to its previous levels. Number 7. You can protect your money by diversifying your investments and being prepared for an economic downturn. The economy crash of 2022 was a difficult time for many people. If you're worried about another crash happening, there are things you can do to protect your money. Diversifying your investments and being prepared for an economic downturn are 2 key strategies. What caused the economy to crash? The economy crashed due to a variety of factors. The most significant factor was the housing market bubble. This bubble created an artificially inflated demand for housing. which led to reckless lending practices and over-leveraging by both borrowers and lenders. When the bubble finally burst, it caused a ripple effect throughout the entire economy, as consumers tightened their spending, businesses cut back on investment, and unemployment rose sharply. Other factors that contributed to the economic crash include high oil prices, rising food prices, and the subprime mortgage crisis. How long did it take for the economy to recover? It took several years for the economy to recover from the crash. The stock market began to rebound in 2009, and by 2013, the economy was growing at a moderate pace. However, many people continue to feel the effects of the crash, as unemployment remains high and wages have not yet returned to their pre-crash levels. What policies were put in place to help the economy recover? A variety of policies were put in place to help the economy recover from the crash. The most significant policy was the Troubled Asset Relief Program, TARP, which provided billions of dollars in bailout money to banks and other financial institutions. Other policies included the stimulus package, which injected billions of dollars into the economy, and the Dodd-Frank Wall Street Reform and Consumer Protection Act, which enacted stricter regulations on the financial industry. What has been the impact of the economic crash on society? The economic crash has had a number of negative impacts on society. One of the most significant is the rise in poverty and inequality. The number of people living in poverty increased sharply after the crash, as job losses and pay cuts left many families struggling to make ends meet. The gap between the rich and the poor also grew during this time, as the wealthy were able to weather the storm better than those with lower incomes. The economic crash also led to an increase in homelessness, as foreclosures and evictions left many people without a place to live. Finally, the crash has had a negative impact on mental health, as anxiety and depression have risen sharply in recent years. What are the long-term effects of the economic crash? The long-term effects of the economic crash are still being felt today. The most significant effect has been the rise in unemployment and underemployment. This has led to increased poverty and inequality, as well as a decrease in social mobility. The crash has also had a negative impact on retirement savings and investment, which has contributed to a decline in living standards for many older Americans. In addition, the economic crisis has led to a decrease in consumer confidence and an increase in business uncertainty, which has further slowed down economic growth. How will this affect the average person? When the economy crashes, it can have a ripple effect on everyday life. The average person may see a decrease in their wages or job prospects, and the cost of living may go up. This can make it difficult to pay for basic necessities like food and shelter. In addition, the value of savings and investments can plummet, leaving people with less financial security. The psychological impact of an economic crash can also be significant, leading to anxiety and even depression. In the most extreme cases, an economic crash can cause social unrest and riots. This can put people in danger and damage infrastructure. The aftermath of an economic crash can be devastating for individuals and society as a whole. What can you do to prepare for an economic crash? There are a few things you can do to prepare for an economic crash. Firstly, try to diversify your income sources so that you're not reliant on just one source of income. Secondly, build up an emergency fund that can cover your living expenses for at least 3 months. This will help you weather any financial disruptions caused by an economic downturn. Finally, consider paying off any high-interest debt before an economic crash hits, as this will save you money in the long run. An economic crash can have a ripple effect on everyday life, so it's important to be prepared. Try to diversify your income sources, build up an emergency fund, and pay off high-interest debt before an economic downturn hits. What can be done to prevent this from happening again? There are a number of things that can be done to prevent another economic crash from happening. Firstly, it is important to ensure that there is strong regulation in place for the financial sector. This will help to prevent excessive risk-taking by banks and other financial institutions, which can lead to crashes. Secondly, it is also important to have a well-functioning social safety net in place. This will help to protect people from becoming too deeply indebted if they lose their jobs or face other financial difficulties. Finally, it is also important to educate people about personal finance and investment so that they can make more informed decisions about how to manage their money. The 2008 economic crash was caused by a number of factors, including lax regulation of the financial sector, excessive risk-taking by banks and other financial institutions, and a lack of understanding among the general public about personal finance and investment. There are a number of things that can be done to prevent another economic crash from happening. Firstly, it is important to ensure that there is strong regulation in place for the financial sector. This will help to prevent excessive risk-taking by banks and other financial institutions, which can lead to crashes. Secondly, it is also important to have a well-functioning social safety net in place. This will help to protect people from becoming too deeply indebted if they lose their jobs or face other financial difficulties. Finally, it is also important to educate people about personal finance and investment so that they can make more informed decisions about how to manage their money. So this was our today's video. I hope you all like this video. Don't forget to hit the like button and subscribe my channel, and also share it with your friends and family. We will be back soon with a new video. Till then, keep supporting and take care. Cryptocurrency and Bitcoin market expansion forecast for 2023. Hello viewers, welcome to my YouTube channel. Today in this video we will talk about cryptocurrency and Bitcoin market expansion forecast for 2023. Everyone has heard of Bitcoin. As the coin that started the cryptocurrency movement, Bitcoin has positioned itself at the top of the pile, and after a stellar 2021, Bitcoin looks set to experience some remarkable value increases in the months that lie ahead. According to Bitcoin price prediction, the price of BTC will reach $33,748 by the end of 2022, rising to $69,712 by the end of 2023, and $90,000 by the end of 2025. Bitcoin will then rise to $161,118 in 2027. And $295,000 in 2030. Bitcoin price prediction overview. At the time of writing, the Bitcoin price today is hovering around the $19,500 level, following a sustained downtrend over the past few months. To help provide an overview of BTC's long-term outlook, presented below is our price forecast for the years ahead. End of 2022. Bouncing back from the current decline, Bitcoin will see highs above $60,000 again in 2022 and reach a top price above $35,000. End of 2023. Once the Bitcoin price begins a bull run, it can sustain itself for a period of months. Thus, assuming the momentum continues, we could see BTC return to the $69,000 level by the very end of 2023. End of 2025. Over the coming years, although some of the best altcoins may develop better utility and uses than Bitcoin, the leading cryptocurrency should retain its ranking due to its first-mover status. Due to this, our Bitcoin price forecast estimates the coin could reach a value of $90,000 by the end of 2025. End of 2030. With the acceptance of BTC reaching epic proportions in 2030, Bitcoin will appreciate above $1 million per coin to hit an all-time high above $150,000. Bitcoin price history. Analyzing Bitcoin's price history is one of the first things you should do when considering investing in BTC. Let's look over some of Bitcoin's most important price movements. What was Bitcoin's starting price? Bitcoin was worth $0 when it was first introduced to potential users in 2009. BTC wasn't given value until July 2010, when exchanges began to sell it for 9 cents. Highest Bitcoin price ever. Bitcoin's all-time high is $68,789.63, which it reached on the 10th of November 2021. What was Bitcoin's lowest price? CoinMarketCap records Bitcoin's all-time low as $65.53 on the 5th of June 2013. In 2021, Bitcoin started the year at $29,374.15, hit its all-time high above $68,000, and ended the year at $46,306.45. BTC's 52-week low is $28,893.62. So far in 2022, the price of Bitcoin has dropped by over 60% at the time of writing in October 2022. Bitcoin price prediction 2023. The growing crypto market will continue to find new ways to market Bitcoin to new investors who have never invested in crypto before. This development should help the leading digital currency continue growing over time, which is why our Bitcoin price prediction 2023 estimates the coin could be worth $68,000 by this point. So this was our today's video. I hope you all like this video. Don't forget to hit the like button and subscribe my channel, and also share it with your friends and family. We will be back soon with a new video. Till then, keep supporting and take care.
Bitcoin, the new money? Hello viewers, welcome to my YouTube channel. Today in this video, we will talk about Bitcoin, the new money. However, before we start our countdown, we would appreciate it if you would subscribe to our YouTube channel and also press the bell icon. So let's get started. Bitcoin is a cryptocurrency and a payment system, first proposed by an anonymous person or group of people under the name Satoshi Nakamoto in 2008. Bitcoins are created as a reward for a process known as mining. What is Bitcoin? Bitcoin is a digital currency which operates free of any central control or the oversight of banks or governments. Instead, it relies on peer-to-peer software and cryptography. A public ledger records all Bitcoin transactions, and copies are held on servers around the world. Anyone with a spare computer can set up one of these servers, known as a node. Consensus on who owns which coins is reached cryptographically across these nodes rather than relying on a central source of trust like a bank. Every transaction is publicly broadcast to the network and shared from node to node. Every 10 minutes or so, these transactions are collected together by miners into a group called a block and added permanently to the blockchain. How does Bitcoin work? When it comes to Bitcoin, there are a lot of questions. How does Bitcoin work? Who created it? What can you do with it? Is it safe? Bitcoin is a decentralized digital currency, which means that it is not subject to government or financial institution control. Transactions are peer-to-peer and take place between users directly without an intermediary. These transactions are then verified by network nodes through the use of cryptography and recorded in a public distributed ledger called a blockchain. Bitcoins are created as a reward for a process known as mining. Anyone can mine for Bitcoins, but it is a difficult and time-consuming process. When a new block is added to the blockchain, the miner who found the block is rewarded with a certain number of Bitcoins. Once you have some Bitcoins, you can use them to purchase goods and services or trade them for other currencies. Bitcoin can be used online or in physical stores and is accepted by many businesses and organizations around the world. Now that you know the basics, you're probably wondering if Bitcoin is safe to use. The answer is yes and no. Like any form of currency or asset, there are risks involved in using Bitcoin. Who creates Bitcoin? When it comes to Bitcoin, there is no one central authority who creates it. Instead, the Bitcoin network is powered by its users. There are two main ways that users can generate new Bitcoin: through mining or through transactions. Mining is how new Bitcoin is created. Miners are rewarded with Bitcoin for verifying and committing transactions to the blockchain, which is the public ledger of all Bitcoin activity. In order to be eligible to mine Bitcoin, miners need to dedicate time and resources to solving complex mathematical problems. This process is known as proof of work. The other way that new Bitcoin is created is through transactions. Whenever a user sends Bitcoins to another user, they are required to include a transaction fee. This transaction fee goes to the miner who verifies and commits the transaction to the blockchain. Transaction fees are optional, but they incentivize miners to confirm your transaction quickly because they earn a small amount of Bitcoin for doing so. How is Bitcoin different from other cryptocurrencies? Bitcoin is the first and most well-known cryptocurrency, but it is not the only one. There are hundreds of different cryptocurrencies that have been created in recent years. While all cryptocurrencies share some similarities, there are also many ways in which they differ from one another. One key difference between Bitcoin and other cryptocurrencies is that Bitcoin is decentralized, while most other cryptocurrencies are centralized. This means that there is no one central authority who controls Bitcoin. Instead, it is powered by its users. Other cryptocurrencies, on the other hand, are often controlled by a single company or organization. Another difference between Bitcoin and other cryptocurrencies is that Bitcoin is not backed by anything. This means that its value is not based on an underlying asset, such as gold or silver. Instead, its value comes from the fact that people are willing to use it as a form of payment or investment. What is Bitcoin used for? Bitcoin can be used for a wide variety of purposes, ranging from everyday expenses to international payments. Here are some of the most popular uses for Bitcoin. Everyday expenses. You can use Bitcoin to pay for goods and services just like you would with any other currency. Many businesses now accept Bitcoin as payment, including major online retailers like Overstock.com and Expedia. International payments. Bitcoin makes it easy to send money to anyone in the world without having to deal with exchange rates or expensive international transfer fees. Investment. Some people buy Bitcoin as an investment, hoping that it will increase in value over time. While the price of Bitcoin has fluctuated a lot in recent years, it has generally trended upwards over the long term. Crowdfunding. Bitcoin can be used to raise funds for a variety of causes and projects. For example, popular crowdfunding site Kickstarter now accepts Bitcoin donations. Charitable giving. You can use Bitcoin to donate to your favorite charities or causes. Many nonprofits, such as Amnesty International and the Wikimedia Foundation, now accept Bitcoin donations. Gambling. There are a number of online casinos that accept Bitcoin as payment, allowing you to gamble with the currency. Online shopping. You can use Bitcoin to buy goods and services online, just like you would with any other currency. Tipping. You can use Bitcoin to tip people for providing goods or services, similar to how you would tip someone in a restaurant. Micropayments. Bitcoin can be used for very small payments, such as a few cents for an article on a website. This is possible because there are no transaction fees with Bitcoin. 10. Darknet markets. Bitcoin is often used on darknet markets, which are online marketplaces that allow people to buy and sell illegal goods and services. How to get Bitcoin? Bitcoin is a decentralized digital currency without a central bank or single administrator that can be sent from user to user on the peer-to-peer Bitcoin network without the need for intermediaries. Transactions are verified by network nodes through cryptography and recorded in a public distributed ledger called a blockchain. To get started with Bitcoin, you first need to acquire some. There are several ways to do this, including: number 1, buying Bitcoin on an exchange. Exchanges are websites where you can buy, sell, or trade cryptocurrencies for other assets, such as traditional fiat money or other digital currencies. To buy Bitcoin on an exchange, you will need to create an account and verify your identity. Once you're logged in, you can find the BTC/USD pair under the Markets tab and place an order. Number 2, earning Bitcoin through mining. Mining is how new Bitcoin is created. Number 3, accepting Bitcoin as payment. If you're a merchant or service provider who accepts payments in Bitcoin, you can simply provide your wallet address to your customers, and they can send payments directly to that address. Bitcoins and taxis. Bitcoin is a decentralized digital currency without a central bank or single administrator that can be sent from user to user on the peer-to-peer Bitcoin network without the need for intermediaries. Transactions are verified by network nodes through cryptography and recorded in a public distributed ledger called a blockchain. Bitcoin is unique in that there are a finite number of 21 million. Bitcoins are created as a reward for a process known as mining. They can be exchanged for other currencies, products, and services. As of February 2015, over 100,000 merchants and vendors accepted Bitcoin as payment. The Internal Revenue Service classifies Bitcoin as property for tax purposes. This means that Bitcoins are subject to capital gains tax. The legal status of Bitcoin varies from country to country. In some countries it is legal, in others it is illegal. Some countries have not yet decided on their stance. In the United States, the IRS has taken a position that Bitcoin is to be treated as property for tax purposes. This means that gains and losses from Bitcoin are subject to capital gains tax. The IRS has not yet issued specific guidance on how to treat taxes on Bitcoins. In Europe, the European Court of Justice has ruled that Bitcoin is not subject to value-added tax VAT, but is instead subject to the much lower capital gains tax. In Canada, Bitcoins are legal but are not considered legal tender. The Canadian government has not yet released regulations on how to treat Bitcoins for tax purposes. In Australia, Bitcoins are legal and are not subject to any regulations. However, the Australian Tax Office has issued guidance on how to treat Bitcoins for tax purposes. In Singapore, Bitcoins are legal and are not subject to any regulations. In China, Bitcoins are legal but are subject to strict regulations. In Japan, Bitcoins are legal and are subject to some regulations. Bitcoin is still in its early stages and its price is volatile. As such, investing in Bitcoin may not be suitable for everyone. Before investing, please consult with a financial advisor to ensure that investing in Bitcoin is right for you. That's all for this video. Hope you will like and enjoy the video, and more importantly, don't forget to subscribe to our channel and hit bell icon to notify about our new video. Also share it with your friends and family. So bye for now, see you in the next video.
Binance just destroyed FTX. Game over. Hello viewers, welcome to my YouTube channel. Today in this video we will talk about Binance just destroyed FTX. The crypto market continued to be under stress after Binance backed out from purchasing out its arch-rival FTX trading, citing finances, investigation concerns. Binance has scrapped its letter of intent to buy rival crypto exchange FTX after due diligence. Furthermore, there are several reports that FTX mishandled customer funds. Earlier, FTX had agreed to sell itself to Binance after experiencing the cryptocurrency equivalent of a bank run. Customers fled the exchange after becoming concerned about whether FTX had sufficient capital. Ashish Singhal, co-founder and CEO, CoinSwitch, said that the market is experiencing turbulence as the international exchange FTX appears to be in trouble. The FTX collapse has wiped out over $180 billion from the crypto market as digital assets across the board are under tremendous selling pressure. Shivam Thakral, CEO of Bitcoin, India's second longest running crypto exchange, said that Binance has backed out of the deal to acquire FTX, which is driving investors away from riskier assets. Feedback from retail. Institutional investors on withdrawals of their funds from FTX will play a crucial role for market recovery in the coming weeks, he added. Following this, crypto market saw another bout of a steep sell-off, adding more to pain to the already wounded crypto market. Major crypto tokens were in deep red on Thursday. The total crypto market slipped below $850 billion markets, dropping another 5%. This market-wide volatility could have been avoided had the exchange and trading firm involved done their fiduciary duties responsibly. What are Binance and FTX? They're two of the biggest crypto exchanges, which are marketplaces where investors buy, sell, and store tokens. Binance is the biggest crypto exchange by volume by a long way, and FTX is in the top 5, according to crypto data provider CoinMarketCap. What happened to FTX this week? On Wednesday last week, an article appeared in CoinDesk, a crypto industry news service, that triggered a crisis. It claimed that the balance sheet of Alameda, a crypto hedge fund owned by FTX's founder, Sam Bankman-Fried, held billions of dollars worth of FTX's own cryptocurrency, FTT, and had been using it as collateral in further loans. If this were the case, then a fall in FTT's value could damage both businesses, given their shared ownership. But FTT itself had no value beyond FTX's long-standing promise to buy any tokens at $22, prompting fears that the whole institution was a castle built on sand. The slow burn crisis was kicked into high gear on Sunday when Binance chief executive, Changpeng Zhao, tweeted that his company was selling its FTT holdings, worth about $500 million, because of recent revelations that have come to light. Things snowballed from there. The value of FTT collapsed, and FTX customers started withdrawing funds in a bank-run-style exodus. In a message to staff this week, cited by Reuters, Bankman-Fried said the firm suffered a giant withdrawal surge, as users rushed to take out $6 billion in crypto tokens from FTX over a 3-day period. Daily withdrawals normally ran to tens of millions of dollars, Bankman-Fried told his employees. Zhao then stepped in to rescue FTX, agreeing on Tuesday to buy the company, but then announcing on Wednesday that he was stepping away from the deal. Who runs them? They've also been led by two of the most visible and charismatic people in the crypto world, Binance by Changpeng Zhao, and FTX by Sam Bankman-Fried, formerly a trader at Jane Street. Until just a few weeks ago, the curly-haired 30-year-old was everywhere in the crypto industry, backing flailing projects including BlockFi, Voyager Digital, and Celsius. He counted the likes of SoftBank Vision Fund, Singapore wealth fund Temasek, and Ontario Teachers Pension Plan as investors. Zhao is a China-born Canadian citizen who emigrated to Vancouver aged 12, and graduated with a degree in computer science from McGill University IFTEC Montreal. He started Binance in 2017 in Shanghai, but the Chinese government banned crypto exchanges the same year. He's now based in Dubai. Why did they fall out? Back in 2019, Binance invested in FTX, then a derivatives exchange. The next year, Binance launched its own crypto derivatives, quickly becoming the leader in the field. Tensions rose as the two companies increasingly took divergent tacks with regulators. Bankman-Fried was testifying in the US Congress, while Binance was said to be facing regulatory probes around the world. The two companies have also been competing for assets, with both bidding for assets of Voyager Digital. FTX.US, the American affiliate of FTX, won the auction. Zhao and Bankman-Fried have been trading barbs on Twitter for months, feuding over issues ranging from lobbying US politicians to allegations of front-running trades. So what just happened in the crypto world? Over the weekend, Zhao tweeted that Binance would be liquidating its holdings of a token known as FTT, which is issued by FTX. The tweet followed a story from crypto news outlet CoinDesk saying that Alameda Research, a trading house owned by FTX's founder Bankman-Fried, had a lot of its assets in FTT token. That fueled broader concerns about FTX's health and investors began to withdraw money. The FTT token plunged. A day before reaching a deal, Bankman-Fried said on Twitter that assets on FTX were fine and that a competitor is trying to go after us with false rumors. Then late Wednesday afternoon New York time, Binance said it was pulling out of the deal, saying its rivals' issues were beyond our control or ability to help. Binance executives had discovered a gap between FTX's liabilities and assets that may amount to more than $6 billion. A person familiar with the matter told Bloomberg. What's more, US regulators are investigating whether FTX properly handled customer funds, as well as its relationship with other parts of Bankman-Fried's crypto empire, including his trading house Alameda Research, Bloomberg News reported Wednesday. What does this mean for the markets? It's injected a lot of uncertainty for investors who are worried about the potential for spreading contagion given the pivotal role FTX and its co-founder Sam Bankman-Fried played in the industry. FTT, the utility token of the FTX exchange, collapsed by more than 40% Wednesday following a tumble of more than 70% Tuesday. But just about every digital coin is struggling. Bitcoin fell as much as 15% to $15,987 on Wednesday, the least since November 2020, which leaves a lot of holders underwater. What does this mean for FTX users? That's unclear. Clients worried about the future of the exchange have already pulled out $430 million worth of Bitcoin in the space of just 4 days. How does this affect CZ and SBF? It's a huge come down for SBF, who had previously been seen as one of the most accomplished people in the industry. That's playing out in fortunes as well. Bankman-Fried's 53% stake in FTX was worth about $6.2 billion before Tuesday's takeover, according to the Bloomberg Billionaires Index. Based on that fundraising round and the subsequent performance of publicly traded crypto companies, his crypto trading house, Alameda Research, contributed $7.4 billion to his personal fortune. The Bloomberg Wealth Index assumes existing FTX investors, including Bankman-Fried, will be completely wiped out by Binance bailout, and that the root of the exchange's problems stemmed from Alameda. As a result, both FTX and Alameda are given a $1 value. That leaves SBF's net worth at about $1 billion, down from $15.6 billion heading into Tuesday. The 94% loss is the biggest one-day collapse ever among billionaires tracked by Bloomberg. So this was our today's video. I hope you all liked this video. Don't forget to hit the like button and subscribe my channel, and also share it with your friends and family. We will be back soon with a new video. Till then, keep supporting and take care. Cathie would everyone will be terrified. Hello viewers, welcome to my YouTube channel. Today in this video we will talk about Cathie would everyone will be terrified. However, before we start our countdown, we would appreciate it if you would subscribe to our YouTube channel and also press the bell icon. So, let's get started. Undeterred by the market sell-off this year, ARK Invest founder and CEO Cathie would double down on disruptive innovation stocks, and predicted deflationary trends will continue into next year. Non-farm and payroll employment was roughly in line with consensus expectations, up 315,000. Household employment was up, more than 400,000. Now, we pay more attention actually to the household. If you look at household employment, it flattened out and actually went down from March until this month. And so from March through August, effectively it's been flat with this latest 400,000, but if you look inside the 440,000, what you're going to find is that's all part-time, much lower paying jobs. Full-time employment is down, and so that's a problem for the economy. It suggests stress is in strains, more people having to work 2 jobs to make ends meet and pay for food, and energy. And what's also interesting is if you look at the gap between the non-farm payroll employment number that seems to have been charging ahead and the household employment number that's gone flat. That's 1.6 million people right there. So there's a huge discrepancy between those two measures of employment, and the household employment measure includes many smaller businesses, and they often react much more quickly to changes in the economy than do large corporations, which are captured more by non-farm payroll. But some cracks in this report, seasonal factors aside. The unemployment rate did go up from 3.5 to 3.7%. We did have an increase in the participation rate in the labor force, so that certainly is one reason for it. The average hourly earnings were up 0.3%. We now know that they peaked on a year-over-year basis at 5.6% in March. March is an important month here. It seems like a lot of things peaked back then, now we're down to 5.2%. And still that's a huge loss of purchasing power, because inflation during this time was up 8.5%, so you know. More than a 3% loss of purchasing power on a year-over-year basis. The other thing we saw was the average work week tick down. Most people do not pay attention to this number. It just changes by a tenth or two per month, up or down, but it often has an outsized, on average, weekly earnings. So those are even worse because hours have ticked down. The other thing to note is that the Challenger survey, which measures layoffs, broad-based layoffs, those are up 30% year-over-year. This is what I mean. We're seeing all of these headlines and the Challenger survey suggests they are real, and yet we're not seeing it in the employment report. Initial claims, as I mentioned, having spiked at the most rapid rate going into a recession that we had seen, now seem to be settling down. And that's got me wondering about this seasonal factor. The other employment-related number that came out this week was JOLTS job openings. So this skill set mismatch or companies not paying enough to attract labor is still impacting the job openings. The number of opening, I think steady state. They used to be 2 to 3 million, and now we're up to more than 11 million in terms of other economic indicators. Retail sales in the latest month, and personal consumption expenditures both flat. And this is in real terms. And auto sales, and I pay a lot of attention to auto sales. It's a big ticket item. And at a steady state, they're usually 17.5 million units, at an annualized rate here in the United States. So we know because of chip shortages that they were very depressed for a long time. So one would have. Pent-up demand was increasing. Well, the chips are chip availability clearly is easing, and yet auto sales dropped from 13.3. Remember I said steady state is 17.5 and we haven't been there in a long time. They dropped slightly to 13.2, and they probably moved up more because of electric vehicles. Certainly more because electric vehicles are booming and traditional gas-powered car sales are floundering. So this is a big problem for the auto manufacturers. The 90 to 95% of their sales are still gas-powered. And so it was curious for us to see GM reinstate its dividend. I think that was Mary Barr's way of showing confidence that they'll be able to transition into the electric vehicle pretty well. But you know, I don't know. This is a very big shift. Housing is in some ways in free fall. There's a lot of negative sentiment. Housing starts dropped roughly 10% last month. Permits down 1.3. The National Association of Home Builders haven't been this negative since the 08-09. Existing home sales down 6% in July. New home sales down nearly 13%, and that's month to month. If you were to annualize that, you'd get a sense of almost free fall in the housing market. That's what, close to 6% mortgage rates will do. And it's happening. Housing has a very big multiplier out there. A lot of other industries are dependent on it. So, we don't take it lightly. Consumer sentiment did bounce a bit. Boy, the market's around with that. But the bounce was related to gasoline prices coming down, which is great. But it got us to the low points basically that we hit in 08-09. So in other words, we were record lows. It got us back to the low points hit in 09-08-09 and in 1980-81 when inflation and interest rates were in the double digits and Paraman Volcker was being very tough. From a monetary policy point of view, we also know that the consumer saving rate has dropped to 5%. Now it was in the, I can't remember the exact number, but I think in the spike it went to somewhere in 20% when no one could spend any money during the early days of COVID. Now we're down to 5%. We haven't been that low since, I believe, 2009-10. So a lot of people are using this. Hey, because of all the stimulus out there during COVID, there's still $3 trillion worth of a buffer. You can make that same statement when you're talking about consumer worth. Consumer net worth is $130 trillion. What that means is assets. So stocks, bonds, houses, and other longer-lived durables like cars, minus liabilities, how much we owe. And that's 130 trillion. And that's been going up regularly. It gets knocked during recessions. It's being knocked a bit right now, but that's a huge buffer too. So I think that, and that narrative seems to be making the rounds and fueling this idea that the consumer's going to continue to spend. Well, if you look at good spending, the consumer in real terms, the consumption of goods is down and has been falling for the past year, and it's still above the trend that was in place pre-COVID. And the inventories are massive. Nancy Lazarus Piper does seasonal adjustment of company inventories. And if you look at Walmart, again, one of the best managed companies in the world, its inventories in the July quarter did not go down, and we had already said, my gosh, they're swimming in inventories. So I think they're going to have to start slashing prices to get the consumer to bite onto inflation. And as part of the economic indicators, got a lot of reinforcement. The Fed did from the headline numbers, which again may be distorted one way or the other. PCE deflator, which the Fed pays most attention to, this down 0.1% month to month in July. So that's deflation, the core rate, which they pay more attention to. Again, taking out food and energy. As I mentioned before, it was up 0.1% and has dropped from 5.3% in March to 4.6%. Again, they're looking at 2% vis-a-vis that number. So 4.6% to 2%. So this was our today's video. I hope you all like this video. Don't forget to hit the like button and subscribe my channel. And also share it with your friends and family. We will be back soon with a new video. Till then, keep supporting and take care. Bitcoin and crypto crash in 2022. Terrified. Hello viewers, welcome to my YouTube channel. Today in this video we will talk about Bitcoin and crypto crash in 2022. The crypto markets are collapsing. Across May and June 2022, cryptocurrencies lost approximately $1 trillion in value. Bitcoin experienced a colossal value drop after hitting a peak of £49,838, $60,741 in November 2021. Slumping to £18,976 on the 1st of August 2022. This is devastating for a variety of investors, from average Joes who had pinned long-term savings plans on their cryptocurrency portfolios, to mining companies operating in countries such as Iran, Kazakhstan, and Malaysia. Alongside this, against the backdrop of a global economy recovering from the COVID-19 pandemic and high inflation rates, the threat of multiple recessions across many major countries looms. Is this crypto crash different? Simply put, although inflation may not impact the decentralized nature of cryptocurrency, it impacts the crypto investor. As energy prices continue to climb, the cost of living has intensified, leading many investors to pull their crypto investments. This drop-off made headlines in June 2022 when US cryptocurrency lending company Celsius Network broke trust with investors by freezing withdrawals and transfers. Is this kind of activity part of the risk with cryptocurrencies? However, since it hit the market in 2008, crypto has been characterized by its unique volatility, leading many to view it as a high-risk investment space. The old adage of high risk, high reward may ring true for some in the crypto market. Since 2008, there have been various crypto bull runs, extended periods in market when stock prices are rising. Alongside this, there are outlandish crypto investment success stories. For example, Eric Finman, who took a $1,000 gift from his grandmother at 12 years old, invested it all into cryptocurrency and became a millionaire by the age of 18 in 2017. In 2022, Finman's net worth stands at $5 million. More miners, more troubles. Put simply, Bitcoin mines are typically large warehouses that hold many small computers, or application-specific integrated circuits that connect to the Bitcoin network, and verify the blockchain by solving complex mathematical equations. For Bitcoin mines to work effectively, they require a lot of energy, from powering multiple ASICs to regulating the temperature of the warehouse. Despite the act of mining being seemingly invisible, the power required is significant. The energy pricing crisis following the Ukraine war is hitting these miners hard following an already strained year. Since the second quarter of 2021, there has been a rise in the number of Bitcoin miners, making the process of mining the cryptocurrency more challenging and competitive. Is Bitcoin mining ethical? If the current cloud hanging over the cryptocurrency industry does begin to lift and prices start to recover, the ethical concerns surrounding mining practices will remain. This is particularly troublesome for countries that have become synonymous with the activity. The Iranian government has taken an involved approach to crypto mining. In 2020, Iran was responsible for an estimated 4% of the global hash rate, making it a significant mining location. Yet blackouts and power outages in the same year were attributed by the government to the miners. As a result, the government shut down 6,914 unregistered crypto companies in the country between 2020 and 2022. If the crypto mining industry continues to contend with high energy prices, climate concerns, government bans, a swamped market and a dwindling value, then its future looks quite bleak. So this was our today's video. I hope you all like this video. Don't forget to hit the like button and subscribe my channel, and also share it with your friends and family. We will be back soon with a new video. Till then, keep supporting and take care.